Imagine a world where your money is worth less every day, and yet job opportunities remain scarce. Sounds like a nightmare, right? Well, welcome to the nightmare of stagflation, where inflation and slow economic growth converge to create a perfect storm of financial distress. But how can we avoid falling into this economic abyss? In this video, we'll be exploring the economic outlook of various economies, the risks and strategies for navigating the treacherous waters of stagflation. Investors are bracing themselves for a challenging 2023 as the threat of stagflation looms large over the global economy. According to the latest MLIV Pulse study, nearly half of the 388 respondents predict a scenario where growth slows down while inflation remains high will dominate the year, with deflationary recession coming in second. An economic recovery with high inflation is deemed the least probable outcome. The survey suggests that investors remain cautious and skeptical of a rally in markets, despite a recent uptick in stock prices. The S&P 500 is expected to be range-bound in 2023 as earnings deteriorate. Meanwhile, the dollar is projected to continue its decline. Against this grim backdrop, over 60% of survey participants believe that investors around the world are still too bullish on asset prices. It appears that the effects of central bank tightening, surging inflation, and the geopolitical tensions caused by Russia's invasion of Ukraine will continue to cast a shadow on risk assets in the year ahead. Nicole Kornitzer, a Paris-based portfolio manager at Kornitzer Capital Management Inc., overseeing approximately $6 billion, has painted a bleak picture for the economic outlook in 2023. Definitely stagflation is the outlook for now, said Kornitzer. She also predicted that the dollar is likely to weaken throughout 2023, although not dramatically, but the trend will probably be downward. Kornitzer emphasized that a recession in the US and the direction of rates would be key catalysts for the currency. According to the World Economic Forum's chief economist's outlook, the economic outlook for 2023 will vary depending on the region. While almost 20% of the respondents foresee an extremely likely chance of a global recession, which is double the number compared to the previous survey in September, there are significant variations between geographies. The global picture appears gloomy, but the survey highlights variations in economic outlooks depending on the region, indicating that the next year will be challenging for the world economy. The latest economic briefing from the World Economic Forum states the majority of chief economists anticipate moderate or strong growth in the Middle East and North Africa and South Asia regions. However, more than 90% of them predict weak growth in the US and Europe. The survey was conducted in November and December 2022 and captures the thoughts and expectations of prominent chief economists from the public and private sectors. Since the survey, the World Bank has projected a global recession for 2023, with GDP growth estimated at 1.7%, the slowest pace since 1993, except for the 2009 and 2020 recessions. Despite the variations in growth expectations among different regions, the global outlook appears dim, with the World Bank's prediction indicating a challenging year ahead for the world economy. The US economy is currently showing resilience, but is projected to slow down due to the Federal Reserve's tightening policies. As a result, household spending is expected to flatten, business investment will decline, and housing construction will fall. The outlook for 2023 is a mild three-quarter recession starting in Q2, with gross domestic product expected to grow by only 0.6% for the year. These figures have been revised higher since the global outlook was published in November. In the Eurozone, high inflation and slow wage growth continue to hinder real household disposable incomes. Additionally, the rising cost of gas is impacting corporations and eroding the trade surplus. A contraction in real GDP of 0.1% is expected in 2023. Despite the pessimistic outlook, survey respondents suggest that US inflation is more likely to fall below 3% than exceed 10% in 2023, indicating some relief towards the end of the year. This will be a welcome development for Fed officials, who have already indicated a preference for a 50 basis point hike in December to mitigate the risks of over-tightening. According to the World Economic Forum's report, Europe is expected to suffer due to the escalating Ukraine war and the adverse effects of the significant interest rate hikes. The report also highlights that the tightening of monetary policy could further hinder the prospects of US growth. The International Monetary Fund has revised its global growth forecast down by 0.2 percentage points, with the Eurozone taking a severe hit, down from 1.2% to 0.5%. The IMF predicts that global growth will slow to 3.2% in 2022 and 2.7% in 2023, marking the weakest growth rate since 2001, except for the global financial crisis and the COVID-19 pandemic's acute phase. Let's switch the global location for a little while and take a look at how this situation looks in other parts of the world. In December, China's sudden relaxation of COVID restrictions prompted research analysts to revise their 2023 real GDP growth forecast upward by 100 basis points to 4.8% year-on-year. However, their estimate remains lower than the market consensus of around 5%, as concerns persist over high household debt, an unstable housing market, and unequal distribution of savings. In December, credit growth was slower than anticipated. While India and Brazil have shown positive developments, the current global real GDP growth forecast of 2.2% by Barclays Research is among the weakest outcomes in decades. According to the report, the Middle East and North Africa, as well as South Asia, were perceived as the best performing regions. The shift in global trends, which is diverting from China, is likely to benefit several economies in these areas, including Bangladesh and India. However, the ongoing challenge of weak growth and high inflation presents policymakers with difficult decisions. Balancing the need to curb inflation while avoiding hindering growth is a major challenge that calls for well-considered monetary policy. In 2023, inflation rates are predicted to decline globally, mainly due to weakened demand and some alleviation of supply chain bottlenecks. However, our research analysts believe that inflation will still be above the 2% target of central banks by the end of the year. In the US, for instance, disinflationary forces seem to be gathering strength. The headline CPI decreased to 6.5% year-over-year in December, the slowest rate since October 2021. However, the overall narrative of core goods deflation and robust core services inflation, supported by shelter, appears to be unbroken. The ability of the Fed to slow down labour demand and wage inflation will be crucial to returning inflation to the 2% target. Central banks in the US and elsewhere will be put to the test as economic activity wanes and unemployment increases, causing real economic hardships that could lead to greater societal pressure to relax restrictive policy stances. The current outlook of stagflation can be attributed to recent events and policy decisions. In 2021, the global economy rebounded from the COVID-induced recession due to substantial fiscal and monetary support, resulting in supply and demand imbalances that led to inflation levels not seen in decades. This brought an end to the era of the Goldilocks economy, where policymakers could stimulate growth without inflationary consequences. The current landscape is characterized by a simultaneous increase in interest rates, record high levels of debt, record low unemployment rates, and geopolitical tensions causing labour and manufacturing supply chain constraints. Therefore, stagflation is the most probable outcome during this transitional phase of the global economy. According to a report, weak global demand remains the major hurdle for businesses to overcome in 2023, followed by expensive borrowing, high input expenses, and shortages of skilled labour. It was highlighted that geopolitical trends were a significant factor influencing global economic activity in the upcoming year, leading to challenges and opportunities for businesses in terms of trade, investment, labour, and technology. The report further added that the collapse of the cryptocurrency sector is anticipated to have minimal impact on broader financial markets, and most chief economists do not expect additional economic disturbance from COVID-19. The policymakers are faced with a difficult decision of whether to tighten monetary policies excessively or inadequately. Fiscal policymakers are also confronted with significant challenges, especially due to the reduced fiscal space following government spending during the pandemic. Despite the uncertain and bleak economic outlook, there are still potential positive developments, such as the easing of inflation and the potential for stabilization and improvement of consumer sentiment. Although the cost of living crisis remains a major concern affecting many individuals, 68% of survey respondents predict a reduction in severity over 2023. Thanks for tuning in to today's video on the potential risks of stagflation. Remember to stay informed and keep an eye on economic indicators to stay ahead of any potential challenges. Now, we'd love to hear from you. What steps do you think individuals and businesses can take to protect themselves in the events of stagflation? Let us know in the comments below.